Good afternoon, Carl.
Hello, Michael Kitces.
How are you doing today?
I am actually fantastic. It's a beautiful day. We've had a bunch of thunderstorms and lightning over the last couple of days. Now it's blue sky and sunny and everything's green. It's amazing.
So that part of the, I guess, late summer as of when we're recording, is that the late summer weather before we head into the fall here?
Yeah, so we typically get some like August monsoon sort of stuff. It's super fun to watch because it's pretty dramatic. So it's been fun, but it makes everything green for a day.
Yep.
Which is amazing.
Yeah, we get a similar effect here in the DC area. You get these storms that build up on the mountains and then like roll off the mountains down out to the ocean. So we'll get these 3, 4, 5 o'clock in the afternoon, just thunderstorm torrential downpours that blow through in 20 or 30 minutes as the clouds roll in and out.
Yeah, so good. So good.
Well, so ironically, although I don't think you even knew where we were going today, like that's actually like apropos to a good metaphor for the discussion I wanted to bring today.
Oh no, thunderclouds on the horizon.
Yes. So had a message come in from we'll call him Harry. So Harry had asked, like, how do we as advisory firm owners, especially newer advisory firm owners, prepare for the next market downturn, economic downturn? So as Harry puts, like, seems like almost every firm I know, like younger advisors, established firms, everyone seems to be growing well right now. Like AUM's up, client counts up, prospect funnel's doing pretty well. Lots of firms hiring, right? I mean, we've been talking more about hiring in teams on this podcast. And as Harry puts it, the longer the bull market goes on, the more nervous I get. I being Harry, I came into the business after the Great Recession. So my first job was in 2010. Wow. And I was entry level, not leadership at that point. So for those who haven't been through a crash before, I guess Harry's not counting pandemic here, since that was like the super sharp V, like we came back so quickly. For those who haven't been through a crash before, how do we prepare?
It's such a great question. And so interesting to me. I let me just set like some big contexty things, and then you can dive in with where I think one thing to keep in mind is that risk is an arbitrary concept until you experience it.
I was going to say, you're saying like risk is an arbitrary concept. I'm like, not when you have to make payroll.
Yeah. Until you experience it, right? Like rehearsing being punched in the face is completely different than being punched in the face. And so there's this tendency, especially as things have gone on a while, as Harry's sort of pointing to think of like, oh, that was quaint, or that was kind of hard. Like you kind of forget how hard it really was, or how hard it really can be. It doesn't have to be, but how hard it really can be. So like, that's kind of my first step, is just to realize like and I'm thinking more from the advisor's perspective than for the clients. There's lots of things we could talk about scary markets conversations and how to have those. But I think we're more framing this for the advisor, right?
Yeah, I was thinking the same thing. There is a whole like, doing the proverbial like fire drill with clients, talking through markets may get more volatile. What does that mean? How do we think about that in terms of the portfolio? But yes, I think Harry's question is very much in the context of how do we, like, what do we think about as business owners, right? Because at the end of the day, particularly for the overwhelming majority of us on the AUM model, our business model is just market volatility amplified.
Yeah.
Because we get all the upside of the market rise, all the downside of the market decline, magnified by our operating leverage, right? If my staff costs are lower than my revenue from the markets, I make more and more profits as the markets go up. And right, and oversimplifying the math a little bit, but if you run a 30% profit margin and portfolios are down 30%, your margins just went to zero because your revenue goes down 30 and your expenses still are what they are. So we bear the good and bad of the operational leverage that goes with that.
Yeah, I'd love for you to talk a bit about that. And what I would like to talk about mainly is just the emotional and psychological side of it, because I think that's really important. Because on top of that,
Yeah.
you keep in mind that your job is to show up every day and give people advice with incomplete information in conditions of uncertainty,
Yeah.
irreducible uncertainty. Like, you're not going to be able to get rid of it. And there are going to be times, I still remember 2007, 2008, I still remember closing the conference room door. People have heard me tell the story, I'm sure, but I can remember the handle on the door rather than going into the whole story, because I've told it before, but I can still remember closing that door of the conference room after meeting with Dan and Barbara and looking them in the eye and saying, you got to stay the course. You got to stay the course, because that was the best advice I could give at the time. But I remember closing the door. I remember the feel of it and everything, and thinking to myself, gosh, I hope I'm right.
Well, I think
For the
there's
first
a
time in my
lot of that
career.
for those of us who went through financial crisis 07, 08. I mean, I started in 2000s. I mean, I got the tech crash
Yeah.
out
Yeah.
of the gate, but the tech crash was like weirdly concentrated because
Yeah.
the technology stocks got decimated.
Yeah.
Large cap growth got hit horribly. Small cap value finally got its love and was this
Right.
amazing diversifier. And the
Right.
bonds held up decently well as a diversifier. Like the Fed cut rates, the quote unquote normal market response happened. And for better or worse, like it was kind of a slow motion train wreck. So the bad news is it was like 2+ years from top to bottom. But the
Yeah.
good news, like it was 2+ years from top to bottom. We bled out very slowly in a way that was a little bit more manageable. Whereas the financial crisis, like the world is melting down, the market's lurching down 11, up 13, like double-digit days, multiple days in a row. And you're on
Yeah.
with clients telling them to stay the course. It's like, I really hope it doesn't turn out that the financial system actually is melting down, because that would be unfortunate.
Yeah. I just don't think you can underplay or overplay the significance of the toll that takes, or can
Yeah.
take on you, especially if you're under resourced, if you think coffee and donuts is a good breakfast, aren't getting sleep, all those things. Because there's times when, and you see this in military doctrine, sometimes there's times when overconfidence is a strategy.
Yeah.
And like, you don't want your EMT
Because
to
reality would not actually be helpful.
yeah, you don't want your paramedic to show up and go, you know what, I don't think you're going to make it. Like, you want the paramedic to say, even if they already know, you want them to be saying, stick with me, come on. Like, so there are times when you might need to be overconfident, even in the face of uh, irreducible uncertainty, and the physical toll that takes on your body when you feel like fight or flight yourself, but it's your job to sit in the seat and be steady, what's the old poem, the mountain in the hurricane. And so I think that's one thing I would be doing, is being like, look, how do I deal with uncertainty? What are the sorts of things I could do to get my nervous system in a place where I feel confident? And that we all know those things, like get a little bit better sleep. And these are things we should be doing anyway. That's the good news here, right? Like, exercise, eating a little better, getting better sleep. Those things all make us more resilient, because the thing, and if I could draw this for people, like how things are going, if you just had like a normal stock market chart going up and to the right, and you just like labeled that what I could handle, and underneath it you had a really spiky line chart going up into the right, and it's like what was happening. Well, the gap between what I can handle and what's happening is like my resilience gap.
Yep.
Well, if that thing crosses, and we can move those lines up just by getting better sleep, thinking through things. And then that, to me, is the emotional, psychological thing we could do to be preparing for it, because I just don't think we talk about that enough. I know that's what knocked me out, right? Like, that's why I ended up in New Zealand, was like I just was a broken human. The business survived, it was okay, right? But I wasn't sure. I remember for 2 or 3 years after 08, I remember like every day kind of feeling like, when's this going to happen again, and thinking like, I don't know if I can handle it. So I think that's important to understand. And I don't think we talk about it enough. But I mean, first of all, comment on that. But second, like, what are you thinking? What comes to mind when you get this email from Harry?
So, part of my head, it does go very much to where you went as well. Just, yes, it is psychologically traumatic, right? To have to be, what was you said, the mountain and the hurricane,
Yeah.
because we're bearing all, like,
Hmm.
we're taking the venting and the brunt of all of our clients trying to emotionally unload the fear and everything that's going on, right? And to some extent, you know, if you're trying to help them vent and work through it, it's basically like, come on, just like get it all out,
Right.
talk through
Right.
it, like let's lay it all out there. What's going on? What's scaring you? Let's talk through this. Uh, and then you have to carry all that after they leave.
Yeah.
After they leave
In
your office.
addition to like looking at your own balance sheet and your own income statement and your own, both personally for your own investments
Yeah.
and for the business. So it's like this giant,
Yeah.
this is why I think it's a tough job. This exact topic, because the very thing, like you're so concentrated.
Yep. Well, and look, in that vein, you know, shifting maybe a little bit to the business end,
Mm-hmm.
you know, I know there's a lot of people that, you know, like question how profitable advisory firms are, question how profitable AUM firms are in particular, as there's still a lot of industry debate about business models and like AUM firms running 25-30% margins. And I look at that and I say, like, you know, having been through multiple of these bear market cycles over my career, I'm like, well, yeah, I sure hope you're running at least 25 or 30% margins, because that's that is your first round of defense when the market gets crushed for a year or two, and keeps you from going upside down where you got to put money in to make payroll if you've got any level of staff team. If you're literally just running solo for yourself, you get a little bit more flexibility and just need to put food on your own table, as it were. But when you've got team on board, right, it oversimplifies the business a little. But if I run 25% profit margins and and my portfolios are down 25%, my profits just went to zero.
Hmm.
And the problem is not that your profits go to zero. That's part of the deal. Like, you get your 25 to 30% profit margins because 1 or 2 years every 10, your profits go to near zero when the bear market comes through. That's part of how it averages out. The problem is, if you're not running healthier margins, then you go negative when the bear market comes through. And that's when things get really, really bad very quick, because now suddenly you're in the realm of, I have to put in money I may not have to make payroll, or I
At
have
a
to
time
cut
when nobody
expense.
wants to, yeah, at a time when nobody wants to give me any money too.
Correct. Or I have to cut expenses, which means cutting people. So at the
Mm.
exact time that my clients are having like peak needs for service and support, I'm going to downsize my staff,
Mhm.
which is where really bad downward spirals can start to happen for advisory businesses.
So
So
what do you do about that on the business side? Like, how do you think about preparing for that, or just
well,
being thoughtful? I want to be clear. Like, I don't feel like this is doomsday preparing. This is
no, I
just
mean,
like
this is just,
this is the business model you chose.
yeah, right. Markets get 40+% declines from top to bottom, with some regularity of bear markets, give or take a few points. Granted, most of us are not 100% in equities, but if you got a good old fashioned 60-40 portfolio, you're going to be off somewhere in the neighborhood of 20 to 30, depending on quite how steep that market decline is and quite how much your diversifiers end out diversifying you in helpful ways.
Hmm.
And again, I don't think it's coincidence that you see a lot of advisory firms run 20 to 30% profit margins when markets when balanced portfolios can have 20-something% top to bottom drawdowns.
Hmm.
That is your line of defense. So the first thing I would emphasize overwhelmingly before anything else is, this is why having a healthy profit margin matters. This is why I get really concerned anytime I see an advisory firm that particularly has a profit margin below 20. It's not because I'm trying to say like you should be, greedier and like leech more money off your clients in excessive economic rents. This is the margin that you need to be able to withstand the hurricane as the mountain. Like this is what you need to be able to withstand the volatility. It matters. Like your margins are your first line of defense. And then the good news is when you've got healthy enough margins, for a lot of firms, that is the entire sufficient defense for the business, with like an asterisk on the personal end I'll come back to in a moment. But like your margins are your first defense. Your second, to me, shortly thereafter, is any level of flexibility that you have in your expenses. So, most of us don't exactly hire a team that we don't need. And most of our other costs are just like the software I use to run my business, which is not very flexible. I need it to run my business. My office space, if you do have a physical office space, it's kind of hard to just like ditch out of the rent when markets get tough. Your landlords don't tend to like that. So for most firms, I see the biggest flexibility that you get in expenses to be able to manage this a little bit further is having some layer of variable compensation or bonus structures tied to your team. And the bonuses are tied to some combination of revenue and profits. And the bad news, if you want to do it from the profitable firm owner end, like the bad news is that it means you pay people a little bit more when markets are good. And the good news is that means the structure is built for your team to share with you a little bit when times are difficult. We didn't have growth this year. The bonuses aren't getting paid. Now, your team did not sign up to be a business owner and take all the volatility that comes with being a business owner. So that doesn't mean you can give them the compensation volatility that you get as a business owner. But having even just 5 or 10% of compensation be some kind of bonus structure that probably is not getting paid out when profits are near zero and revenues are down in a market helps a lot. For a lot of advisory firms, 70 to 80% of our costs are staff comp. So if 5 to 10% of those costs are variable compensation that comes off your shoulders, that's another 5% in margins that you have as like a buffer in a downturn. Smart. That goes a long way to, if you're running 20 something in the market and the portfolios are down 20 something, that margin can be that bonus that doesn't get paid can be the difference between being able to get through or needing to either put money in to make payroll or needing to cut someone because there's not enough dollars going around.
Yeah, that's really smart.
So just the financial management of the business. Once you've got team, it's a little bit different. If you're solo, you just got to feed yourself. And we usually have better margins as, or EBOC or some kind of owner take home. But once you've got team and, responsibility for other mouths to feed, to me, this is where the financials and the financial management of the business and its margins matters. It's not just your profits, it's your ability to withstand external shocks to the business, the most straightforward of which is markets tend to do crazy things every 1 or 2 of 10 years.
Yeah. Are there, I'm loath to use the term stress test, but have you seen that be helpful for people? Like, hey, let's just and I mentioned earlier, like pretending to be punched in the face is different than actually being punched in the face, but it still could be helpful.
Oh yeah.
To run through real examples. So what would you do there?
Yeah, ironically, now I was saying all the discussions we had about stress testing and portfolios, I haven't heard it referred to as a stress test before, but I have a few advisory firm friends that run basically what they call rehearsals. All right, like things go crazy, markets down, markets down 30% plus next year, balanced portfolios down 20 plus. Let's just literally take a couple hours and run through how this shows up in our P&L.
Yeah.
Like, let's just kind of project out, we usually don't have a ton of line items in our business, right? Markets don't go down in a month. So, They do it over a couple of quarters. So model your revenue going down over several quarters as your profits get chewed up. What is my payroll? What are my other expenses? If I do have something like a little bit of variable comp or bonuses that don't get paid, how does that play out? Like, just run it on a spreadsheet to
Right.
see how does this actually work? How does this play out? And again, in general, I find if you've got healthy margins, it works okay. If you don't have healthy margins, it gets pretty squeezy. But then even in the context of a rehearsal, you can start going through like, cool. So if the math is starting to turn upside down, like what would we do? Let's kind of rehearse this and play it out. Like, am I gonna cut bonuses? Am I going to, is there someone I could lay off that maybe sort of needed to go anyways, and this will just end up being the excuse? Can I not afford to let go of anyone? And my response would be, I'm just gonna have to go to the team and say, look, I've got to dial everyone's comp down by 10%. The good news, I don't have to lay anyone off. The bad news is like, we just all have to take a little bit of pain. Hey, my profits are going to zero, so I'm taking the most of it, but I've got to take everybody's comp down a little. I know a few advisors that did that in the financial crisis as a way to keep from needing to let anybody go. Would you borrow if you could? Would you run up any credit card debt? Would you take out a HELOC? Right? Not saying whether you should or shouldn't. You know your business and your risk better than I do, but it doesn't hurt to just think through in your head, like, would you do that? And, preparing, I would totally do this as a HELOC. Cool. Do you actually have a home equity loan open now? Because in the middle of the market decline, probably won't be the best time to set that up if you don't have it now, right? Maybe we should put that buffer in place.
I love the idea of identifying, because that, obviously these are very similar to what we do with clients, but the idea of identifying the levers you'd pull beforehand even in the priority order that you would pull them, all representing guesses, right? As just a model, but at least then you have something to go to when you're not I mean, you might be feeling a little stressed, a little worried. It's just so helpful to have a plan that you can refer to beforehand, right? When you're thinking about doing something silly, it's kind of cool to be able to revert back to a plan. So I love the idea of identifying the levers, especially.
Now, the piece I will note, on the other hand, the place where I see for advisory firms, I've seen that had some kind of, it's basically like a blow up in a market downturn. I've seen a handful that just ran really thin margins, said, my business is big enough, I run a 12% margin. My business is big enough that 12% margins on the amount of revenue I bring in is more than enough to pay my bills and live my lifestyle. So like, I don't need to run higher margins. And then they got very punished when the market downturn came and they couldn't make payroll. The other version that I've seen, probably even more often, is what blew up the firm was not the market downturn. It had 20-something% margins. They basically went to zero when the market decline came. The problem was the business owner had a lifestyle that was not capable of sustaining a year without profits from the business. Because they basically spent all the profits of the business every year. It's like the business was totally healthy. It ran a good margin. Their lifestyle was to live basically all of that profitability, and they had no capability to manage their personal household expenses and their lifestyle when the profits went to zero. And so like the weird effect was the business was fine, but it imploded because they had to get enough money out for their own really nice house and the really nice second house that they did not want to sell in the middle of the financial crisis, and a couple of cars and a couple of other nice things. And like, I'm not trying to be judgy about lifestyle, but many things with fixed payments that they could not sustain when the profitability went to zero. And just at a more generalized note, where I see a lot of advisory firms struggle at the end of or advisory firm owners struggle at the end of the day, the problem is not actually whether the business is okay. The problem is whether they can pay their own bills in the year that the business has no profits.
Fascinating.
And, true to our recommendations as financial advisors, that's basically a discussion around, emergency fund, emergency reserves, with the caveat that we can bear the full brunt of market cycles that can be down for a year or two. If you want to go all the way back to 2000 to 2002. So, if your business has 25% margins, it may be fine, but do you have 2 years of personal living expenses in cash, or easily convertible to cash if you want to use some alternatives? Cash or easily convertible to cash if you got to withstand a 2-year market cycle downturn. And to me, that's particularly as firms get bigger and have some healthy margins, that's actually the place that I find most advisors have the real stress. So
For sure.
Run healthy margins, and 3 to 6 months of emergency reserves is just not enough when you're the owner of an advisory firm.
Yeah.
Unless you run really big margins. I suppose if you're running 40% plus margins, you'll probably still be able to draw some money out anyways.
Yeah. Yeah, that's it's interesting how, I don't know what the right word is. I want to use the word heavy, but it's not heavy. It's just interesting how real that could get really fast. And I think it's just so smart to be thinking. I'm glad that Harry asked the question, because the time to I had a sketch in the column in the New York Times once. It was a Venn diagram that the Venn diagram police got so mad at me for, because it wasn't really a Venn diagram, but it was something like learning how to use a parachute after you've jumped out of the plane or something. Like it was like a little too late.
Yeah.
Was the overlap was labeled.
Yeah.
And I think, to your point of home equity line, nobody gives you that when you need it.
Yeah. But again,
super smart.
The distinction is it's one thing to manage the downturn in the business. You do that with margins as buffer and some flexibility of expenses. And if you're running margins that these businesses are capable of, that tends to be enough. Your upkeep is your downfall for most advisors. So what are your personal cash reserves if you have to go 6 months or 12 months or 2 years without any material profits out of the business? While you're making payroll and keeping clients on board, like, you can run break even and the business is fine, and we'll eventually get whenever the rebound comes. Can you handle that yourself? Yeah. The one other thing I have to note in here is like ways to do this that just, I know one advisor that did this. I do not in any way support or endorse the strategy. You can do your own math. But so for those who remember, Nassim Taleb's Fooled by Randomness came out in the early 2000s. Yeah. And one of his whole things was, because markets are so asymmetric, you buy, deep out of the money, puts or calls, particularly puts, and you just kind of wait for the inevitable market crash that will, be completely useless 9 out of every 10 years. And in the 10th year, it may pay off. So I had known an advisor who, upon reading that book, had a deliberate strategy. Every year, he took 1% of his revenue and he bought deep out of the money puts.
I was going to ask you about that. Just basically Southwest buying hedges on fuel costs.
Yeah. His revenue was tied to the market. Yeah. And so he hedged against the market. And
what do you think of that?
He would never share with me how the math played out, but he was doing this straight up to and through 2008. And he definitely did not look financially stressed. Yeah. when the market fell out and the VIX went to 40 or 60 or 100 or whatever. I don't even remember what crazy number it got to
Yeah.
in the peak. And I have to presume his puts gave him a bajillion% return, even though he'd lost money for the past 7 or 8 years that the market hadn't gone volatile. And you basically he bought himself a little portion in portfolio insurance, but his motto is this: look, I'm going to do 1% of my revenue. Just means my margins are 1% lower. As a percentage of profit, it was higher because 1% margins when you run 25% margins is 4% of your total dollars. So it was a non-trivial portion of his profits, and he ran it every year. And many years it was a complete waste of money, and the year that it mattered, it definitely wasn't. So to each their own about how they like to do deep put options that will probably go to zero most years, but it is another way to do it and approach the problem. And notably, like, you don't even, assuming you're buying longer term puts, like, you don't actually need them to go into the money if the markets get anywhere close to the level you buy at the strike price. Like, they're going to be highly vested, highly valuable, because there's still value left in the remainder of the term of the option. So
plus the volatility kick.
Yep.
Normally.
Yes. Plus you get a boost. Black-Scholes model looks a whole lot better when volatility goes through the roof. So
yeah, that's so interesting, especially when you don't know, but the odds are that thing is going to show up
at some point.
Yeah. I mean, it would be silly not to think that that's going to show up. So that's super interesting.
Margins, reserves, and maybe deep out of the money put options if you're so
purely. And I think another way to think about it is just an insurance policy.
Yeah. Oh, very much. I mean, he viewed it as business insurance.
Yeah.
Against markets.
No different. I remember when Southwest had that year where they had hedged their fuel costs.
Yep.
I think it was Southwest. One of the airlines had that year where they had hedged their fuel costs, and it ended up being a huge contribution to their profit for that year. So super interesting. Yep. Well, that's enough of that, Michael. That's enough of that. Super, super helpful.
Awesome. Thank you, Carl. Appreciate it.
Yeah. Cheers.